First up, a massive shakeup in the corporate crypto space. Asset Entities shareholders have just overwhelmingly approved their merger with Strive Enterprises. This isn't just any deal. It's poised to create a powerhouse Bitcoin Treasury Company backed by a colossal $750 million PIPE financing. We're talking about a serious strategic pivot that could redefine how public companies hold and manage Bitcoin, with Matt Cole stepping in as CEO and Arshia Sarkhani taking a key leadership role. This merger is set to create a significant player in the market, and you'll want to know all the details. Next, we're diving deep into the heart of Bitcoin itself with the latest halving event. This monumental upgrade, hard-coded by Satoshi Nakamoto himself, has once again slashed the reward for mining new blocks by half. This isn't just a technical tweak. It's a profound reinforcement of Bitcoin's digital gold scarcity, directly impacting miners like Marathon Digital Holdings and Riot platforms, and setting the stage for potential price appreciation as new supply dwindles. We'll break down exactly what this means for the network and for investors. And that halving? It happened in a truly unique context this time, right alongside the explosive rise of institutional dominance. We're talking about the game-changing approval of U.S. spot Bitcoin ETFs from giants like BlackRock and Fidelity. This convergence of programmed scarcity and massive institutional capital has propelled Bitcoin to new all-time highs, fundamentally altering its market dynamics and ushering in an era of unprecedented maturity. We'll explore how this dual force has reshaped Bitcoin's trajectory, pushing it past $124,000 and beyond. Finally, get ready for a whole new way to trade. Derivatives exchange Cboe is set to launch continuous Bitcoin and Ethereum futures for U.S. customers this November, pending regulatory approval. These aren't your typical monthly contracts. They're designed to last a decade, offering investors a truly long-term, perpetual-style market access. Catherine Clay from Cboe highlights how this brings a popular offshore product to a trusted, U.S.-regulated environment. You won't want to miss this development in the futures market. Stick around for all the details and analysis. Don't forget to smash that like button, subscribe to Bitcoin Bulletin, and ring that notification bell so you never miss an update. A Bitcoin treasury giant is born. This is it, the moment Asset Entities shareholders gave the green light to merge with Strive Enterprises, paving the way for a revolutionary Bitcoin Treasury Company poised for the public markets. This isn't just a merger, it's a strategic pivot, bringing together two forces to create a dominant player in the digital asset space. The deal sailed through with overwhelming shareholder approval, a clear signal of confidence in the vision ahead. Strive's shareholders had already given their nod on September 4, 2025, setting the stage for this monumental combination. Once finalized, the merged entity will proudly operate under the Strive, Inc. banner, continuing its journey on Nasdaq under the familiar ASSD ticker. Leading this new powerhouse will be Matt Cole, stepping into the crucial roles of CEO and chairman, while Arshia Sarkhani, the current CEO of Asset Entities, will transition to Chief Marketing Officer and join the board of directors. This leadership structure clearly indicates Strive's strategic direction at the helm. The financial firepower behind this merger is staggering. A substantial $750 million PIPE financing is already secured, injecting significant capital into the new entity. But the potential doesn't stop there. An additional $750 million could be raised through warrant exercises, potentially bringing the total gross proceeds to an impressive $1.5 billion. This massive capital infusion, coupled with a zero-debt profile, positions the combined company to aggressively pursue its objectives, primarily focused on disciplined, long-term strategies aimed at outperforming Bitcoin itself. The company emphasizes its commitment to maximizing Bitcoin per share for its investors, a clear indicator of its core strategy. The market is buzzing with reactions to this transformative deal. Analysts are highlighting the strategic brilliance of the reverse merger approach, which grants Strive immediate public market access without the lengthy IPO process. The substantial capital injection is seen as a game changer, providing the necessary resources for significant Bitcoin accumulation. The leadership transition is also a key talking point, signaling a clear focus on Bitcoin's strategy under Matt Cole's guidance. The ambition to outperform Bitcoin itself suggests a sophisticated approach beyond simple holding, promising exciting developments for shareholders. This landmark merger sets a new precedent for Bitcoin Treasury companies. But what happens when programmed scarcity meets institutional demand? Stay tuned for the next story. Digital gold scarcity reinforced. The latest Bitcoin halving has just rocked the crypto world, and it's far more than just a routine upgrade. This pre-programmed event, a cornerstone of Bitcoin's design, has once again slashed the reward for mining new blocks in half, dramatically slowing the rate at which new Bitcoins enter circulation. This isn't just a technical adjustment. It's a profound reinforcement of Bitcoin's scarcity economics, solidifying its narrative as digital gold and setting the stage for significant long-term implications. At its core, the halving is a powerful demonstration of Bitcoin's deflationary model, a stark contrast to the inflationary nature of traditional fiat currencies. By systematically constricting the supply of new coins, Bitcoin's protocol engineers a unique form of digital scarcity, enhancing its appeal as a store of value. This event, designed by Satoshi Nakamoto to occur approximately every 4 years, specifically after every 210,000 blocks, marks the fourth such reduction in Bitcoin's history. The most recent having cut the block reward from 6.25 BTC to 3.125 BTC, a change that will continue until roughly 2140, when the maximum supply of 21 million Bitcoins is mined. The immediate aftermath of a halving is often described as a supply shock. While immediate price surges aren't guaranteed historical data points to significant price appreciation occurring several months after these events, as the reduced supply gradually influences market dynamics. This deliberate mechanism is critical to Bitcoin's economic model, establishing a transparent and diminishing supply schedule that underpins its value. Unlike fiat currencies, Bitcoin's issuance rate is immutable and predictable. The key players directly affected are the Bitcoin miners, such as Marathon Digital Holdings and Riot platforms, whose primary revenue stream is halved. This squeezes profit margins, especially for less efficient operations, potentially leading to industry consolidation. On the other hand, long-term holders and institutional investors, especially those utilizing regulated vehicles like BlackRock's iShares Bitcoin Trust and Fidelity's Wise Origin Bitcoin Trust, are positioned as potential beneficiaries. A reduced supply, assuming constant or increasing demand, theoretically translates to a higher scarcity premium and potential price appreciation. Market sentiment surrounding this halving remains largely bullish, with many proponents viewing it as a fundamental driver for future appreciation. While initial price reactions were somewhat muted, perhaps due to the event being partially priced in by sophisticated participants after pre-halving rallies, the long-term implications of diminishing supply are undeniable. The halving reinforces Bitcoin's unique position as a scarce digital asset, attracting attention from those seeking hedges against inflation and a reliable store of value in an increasingly uncertain economic climate. This programmed scarcity is fundamentally reshaping Bitcoin's market. But what happens when that scarcity collides with a tidal wave of institutional demand? Find out next. Bitcoin's institutional takeover. Prepare for a paradigm shift. The period between the April 2024 Bitcoin halving and September 2025 has irrevocably reshaped the cryptocurrency landscape, marking an epoch where programmed scarcity met unprecedented institutional demand. Bitcoin, BTC, has shed its speculative image, evolving into a recognized macro asset driven by a powerful confluence of supply reduction and a massive influx of capital through newly approved spot Bitcoin exchange-traded funds, ETFs. This era has been defined by a unique dual force. The fourth Bitcoin halving, occurring on April 20, 2024, at block height 840,000, slashed the miner reward from 6.25 BTC to 3.125 BTC, cutting new supply at its source. Historically a catalyst for price surges, this halving's dynamics were fundamentally altered by the U.S. spot Bitcoin ETFs, approved in January 2024 by financial giants like BlackRock and Fidelity. These ETFs democratized access, drawing billions in inflows from traditional investors, pension funds, and sovereign wealth funds. This institutional demand created a formidable wave that propelled Bitcoin to new all-time highs, reaching over $124,000 by August 2025, a stark contrast to previous halving cycles. The key players in this dramatic shift tell a compelling story. Bitcoin miners, including Marathon Digital Holdings, Riot Platforms, and CleanSpark, faced an immediate 50% revenue cut, forcing strategic investments in energy efficiency and low-cost power to maintain profitability. Meanwhile, institutional ETF providers and their custodians, like BlackRock, Fidelity, and Coinbase, became massive Bitcoin accumulators, often buying more BTC than was newly mined. The sheer scale of institutional accumulation, U.S. spot Bitcoin ETFs alone managing nearly $219 billion in assets by September 2025, removed an estimated 18% of circulating supply from active trading, contributing to unprecedented stability and legitimization. Asset managers like BlackRock generated substantial fees, while MicroStrategy, now Strategy Inc., saw its valuation soar. Even smaller, less efficient miners struggled, facing consolidation as Bitcoin needed to trade above $110,000 for expansion. The impact has been profound. Bitcoin's price appreciation accelerated dramatically, reaching an all-time high significantly faster than in previous cycles. Institutional investors gained straightforward access, transforming Bitcoin into a staple in diversified portfolios. The market has matured, with volatility decreasing and Bitcoin's correlation with traditional assets like the S&P 500 increasing, signaling its deep integration into global finance. The narrative has shifted from speculative frenzy to a recognized macro asset, a testament to the combined power of programmed scarcity and institutional adoption. Bitcoin is now firmly entrenched in traditional finance, but what about the tools traders use to access these markets? We've got big news on that front next. Futures get a perpetual upgrade. Big news for traders and investors in the U.S. Derivatives exchange Cboe is gearing up to launch continuous Bitcoin and Ethereum futures contracts for its customers this November, pending regulatory approval. This isn't just another futures product. These contracts are designed to offer a long-term market, potentially lasting up to 10 years, giving investors sustained access to the two largest cryptocurrencies by market capitalization. Traditionally, futures contracts expire every month, requiring investors to constantly roll over their positions to maintain exposure. However, Cboe is introducing perpetual-style futures, a concept that has already gained significant traction in offshore markets. Catherine Clay, global head of derivatives at Cboe, stated that these contracts will bring the same utility to the U.S.-regulated futures exchange, allowing American traders to engage with these products confidently in a trusted, transparent, and intermediated environment. The key innovation here is the extended duration, moving away from the typical monthly expiration. These new contracts will be cash-settled and closely aligned with real-time spot market prices, ensuring they accurately reflect the underlying asset's value. This development is part of Cboe's broader engagement with the digital asset space, following its earlier filings with the SEC to potentially list ETFs for various altcoins, including a Solana ETF through a joint venture with Invesco Galaxy. Cboe, alongside NYSE Arca, has also proposed changes to the ETF approval process, advocating for automatic listing without case-by-case review, aligning crypto ETF treatment with traditional assets. This move by Cboe signifies a growing institutional appetite for regulated crypto derivatives in the U.S. by offering long-term, perpetual-style futures. Cboe is catering to demand for more sophisticated trading and hedging strategies. It represents another step in the maturation of the crypto market, providing U.S. investors with more robust and accessible tools to engage with digital assets, all within a regulated framework. From corporate mergers to groundbreaking futures, the crypto world is moving at lightning speed. We've covered a lot of ground today, but we're not done yet. Stick around for a quick recap and our final thoughts. And that's a wrap on today's Bitcoin Bulletin. We saw asset entities and Strive enterprises merge to create a Bitcoin treasury giant. Bitcoin's latest halving reinforced its digital gold scarcity. Institutional investors, through ETFs, have propelled Bitcoin to new all-time highs, reshaping its market. And Cboe is set to launch continuous Bitcoin and Ethereum futures, bringing perpetual-style contracts to the U.S. regulated market. What an incredible time to be in crypto! Don't forget to like this video, subscribe to Bitcoin Bulletin for all your crypto news, hit that notification bell, and share your thoughts in the comments below. Follow us on all our social channels for more updates. We'll see you next time.